All right, today we are diving into the mind of an investing giant, Joel Greenblatt. We're going to look at two sides of the same coin in value investing. First, how do you find those incredible bets where the upside is just huge, but the downside is, well, tiny? And on the flip side, how do you steer clear of those value traps, the stocks that look like a steal, but are actually financial black holes waiting to suck you in? I mean, this is the big question, isn't it? It's what every single one of us grapples with. We're all searching for that home run investment, but you can't afford a massive strikeout that just wipes you out. It feels like you can't have one without the other, right? But what's so cool is that Greenblatt basically built his entire career on a really elegant answer to this exact problem. So yeah, our guide for this is the man himself, Joel Greenblatt. He's a legend in what's called special situation investing. And what we're going to do is break down his thinking, his masterclass, really, to see how he just completely flips the script on risk and reward. He basically takes what everyone thinks they know and turns it right on its head. So what's the secret sauce here? Well, it all kicks off with finding what he calls an asymmetric bet. It's a fancy term, but all it means is an opportunity where what you could gain is way, way bigger than what you could lose. And the specific tool he uses to set these up is a special kind of option known as a leap. Okay, leaps. Don't let the acronym scare you off. It just stands for long-term equity anticipation securities. But forget that. Just think of them as long-term call options. They give you the right, but not the obligation, to buy a stock at a set price for a really long time. We're talking a year, maybe two. And that long time frame, that's the key. Because, a good investment idea needs room to breathe. It needs time to prove you right. And here's where Greenblatt's genius really shines through. He has this way of cutting through all the Wall Street jargon. He says, look, forget the super complicated math for a second. Just think about it like this. Buying a call option is the exact same thing economically as buying the stock and at the same time buying insurance on it. That insurance is what's called a put option, and it protects you from a big drop. It's that simple. And this is where the magic happens. Let's make it real. Say you want to get in on a $50 stock. To buy 100 shares, that's $5,000 out of your pocket. If that stock goes to zero, poof, $5,000 gone. But with a leap, your entire bet might only cost you, say, $900 for the premium. Now, if the stock goes to zero, you only lose that $900. That's it. Your max loss is known and locked in from day one. So the big takeaway here is that for Greenblatt, leaps aren't some wild speculative gamble. Not at all. He sees them as a smarter, more calculated way to make a bet on a company. You get the upside, but you've got this incredible built-in protection. It's like playing offense with the best defense in the league on your side. Okay, enough theory. Let's see how this works in the real world. All right, let's get into our first case study, a real-world trade Greenblatt made in American Express, ticker AXP. This is just a perfect example of how it all comes together. You find a great company, and then you use this leap strategy to create that beautiful, lopsided risk-reward profile we've been talking about. Okay, so any solid value investment has to start with valuation, right? You gotta know what it's worth. So for Greenblatt, back in 2005, step one was figuring out what American Express could earn in the future. After doing all his homework, he landed on a projection. By 2007, AXP could probably be earning about $3.20 a share. And that number, that becomes the foundation for everything else. Right, so you have your earnings estimate. What's next? You need a multiple. Basically, how much are you willing to pay for each dollar of those earnings? Now, for a top-tier blue-chip company like American Express, with that brand, that moat, Greenblatt felt a price-to-earnings multiple of 22 was pretty reasonable. And this wasn't just a guess. He based it on the quality of the business and what stocks like it had traded for in the past. And this is where it all clicks together. You just do the simple math. You take his projected earnings, that 320 number, and you multiply it by the multiple he chose, 22. And what do you get? A target price, a sort of fair value estimate of about $70.40. At the time, the stock was trading for way less than that, so you could immediately see the potential upside. So let's just lay out the playbook here. Step 1, do the work. Figure out what you think the business is worth to get a target price. Step 2, structure the bet. Instead of dropping a ton of cash on the stock, use leap calls to capture that upside. Step 3, know your risk. Your absolute maximum loss is just the premium you paid for those calls, maybe $9 in this case. And step 4, calculate the reward. If you're right and the stock hits that $70 target, your $9 investment could turn into $20. That right there is a beautiful asymmetric bet. But what if the numbers you're basing all this on are just made up? And that question brings us to a much, much darker story, the story of Sunbeam. At the time, with its famous CEO Chainsaw Al Dunlap at the helm, it looked like one of the most incredible business turnarounds ever. But as Greenblatt shows us, if you just scratched beneath the surface and ignored the hype, the numbers were screaming that something was very, very wrong. Yeah, this quote really says everything you need to know. All those amazing profits that had everyone on Wall Street so excited, they were fake. They weren't real. This wasn't a story of a business getting better. It was a story of accounting tricks and straight-up fraud.
So how exactly did they pull this off? I mean, it was almost impressive in how deceptive it was. They used tricks like bill and hold, which basically means they sold stuff to themselves and called it revenue. They did inventory stuffing, literally shipping products to stores that never even asked for them just to book a sale. They took normal, everyday costs and hid them in a bucket they called restructuring charges to make their profits look better. It wasn't a business, it was an illusion.
Okay, look at this. This right here is the whole story in one table. The smoking gun. On their income statement, Sunbeam is bragging about making over $109 million in profit. Looks amazing, right? But if you knew to look at the cash flow statement, you'd find the real story. The actual business was losing money. It burned through more than $8 million in cash. Think about that. They were telling the world they were hugely profitable while cash was just pouring out the door. And that is the lesson from Sunbeam. It's so, so important. Earnings, reported profits, they can be played with. They can be manipulated, twisted, even completely faked. But cash? You can't fake cash. Cash flow is the ultimate lie detector for a business. It's reality. And for Sunbeam, the cash flow statement told you the whole turnaround was a sham long before the whole thing came crashing down. All right, so we've seen two completely different worlds, haven't we? On one side, a huge success story built on smart valuation and clever structuring. On the other, a total disaster built on a foundation of lies. So let's bring these two stories together and boil them down into a playbook, some key lessons we can actually use. And here you have it, the tale of two investments. The AXP story teaches us to look for great businesses and then, really importantly, structure our bets for those asymmetric payoffs. Use a tool like a leap to get all that upside potential while keeping your downside super tight. And then there's Sunbeam. That's our cautionary tale. It teaches us to be skeptical, to be a detective. Never just trust the reported numbers. Always remember, cash is king. The cash flow statement is your reality check. Because sometimes that income statement, it's the best piece of fiction you'll ever read. So I'll leave you with this one final thought. Take a hard look at the companies you own. Are you just skimming the headlines? Are you just reading the glossy annual reports and believing the press releases? Or are you really digging in? Go pull up the cash flow statements for your stocks. What's the real story that the numbers are telling you?